Cutler YMX uses the Netrodyne two-way camera system in all of our power units. The Netrodyne cameras have more than once exonerated a driver who was perceived to be at fault, as well as saved our Cutler YMX from paying damages related to an accident. We are already seeing, just in 1 year of Netrodyne, the impact of better safety scores and fewer damages and incidents in our insurance rates.
Welcome to yet again another Thursday afternoon.
Yeah, I mean, it feels like we were just here. Yeah. The weeks feel like they've been going faster recently.
Yeah. I mean, it is the ending of summer months, I guess. Things get a little bit faster. This is Freightonomics, where we talk about the global supply chain environment, freight markets, and economics situation. Zac Strickland, Director of Market Intelligence, Tony Mulvey, Senior Analyst. And also, we're going to have Dr. Zac Rogers on the show today, where we talk about the July LMI readings, amongst other things. But first off, let's do a little housekeeping, Tony.
Yeah, so remove the guesswork from driver management and fleet safety and start predicting your accident reduction cost savings. Netrodyne's AI-enabled video safety platform corrects unsafe driving habits, recognizing and reinforcing great driving. With the Green Zone score, your fleet of engaged drivers will protect your bottom line. Every 50 points earned is a 14% cut to your accident rate. So thank you, Netrodyne.
Yeah, and be sure to check out the Freightonomics, where we interviewed Adam Kahn from Netrodyne and talked about the ROI of some of that risk management and driver safety. Yeah. So, I really want to get to Dr. Z today, but also I want to mention and lead in with a little stock market talk, because this is, the stock market, for those of you that watch it, there's a lot of hyperbole in the stock market. There's a lot of overreaction. There's a lot of emotion there that I want to at least address this week, because I get a ton of questions around this. People tend to take away, I think, more than they should, economically speaking, from the stock market. But that is ultimately what these companies are judged by. Yeah.
But to get there, we need a market in two first. So Zac, I'll count you in 3, 2, 1.
All right, let's start things off with the outbound tender rejection index, still showing a relatively elevated tender rejection index compared to where it has been over the last year and a half, hovering above this 4% range, right around 4.5% today. That is still a very soft number. That is very indicative of a very loose freight market. 4.5% rejection rates tend to mean we're still seeing deflation in contract rates and such. But directionally, we are still in alignment, and a lot of the company earnings reflected this, that we are moving towards a tighter environment in the third and fourth quarter. Take from that what you will. It is very slow. It is not happening dramatically, which I think is a healthy situation in general. But the fact that we're now moving above 2019 and kind of separating ourselves from that level tend to tell me that we're going to have a little bit more vulnerability coming up, especially as the retail peak season and stuff starts to happen. Let's go to the next chart here and look at the refrigerated truckload index compared to the national truckload index. The spot rates, of course, for refrigerated reflected in white, and for the dry van reflected there in blue. Refrigerated market really starting to take off. Spot rates have been consistently and steadily on the uptick since May. Dry van, also similar situation, but to a lesser extent. The refrigerated market having a mini recession, as I call it, mini freight recession in the spring, now appears to be on firm footing, heading into a period of time where we see some seasonal pressure. Definitely a market. Anybody shipping refrigerated needs to watch that. Moving over to demand, outbound tender volume index, starting to see some weakness, at least sequentially showing up here. July and August, not a very robust month, nothing to really, I think, get too alarmed by, but we're starting to approach back to that year-over-year number being flat. Definitely something to monitor as we hit September. I'm not taking too much away from it yet. Go to the last chart here. Contract versus spot rates. Contract rates flatlining, spot rates on the rise. Everybody needs to be paying attention to this heading into bid season.
I think what's been interesting is we got earnings this week, and that spread mean, I kind of look at it as a gauge for margins and margin pressure for especially the brokerages. A lot of what you heard in the second quarter was margin expansion, which is interesting. But I think some of that has to do with some of the mixing, because they tend to just lump all brokerage, so LTL and truckload in there. And how that mix changes can affect margins, even when you're seeing kind of the spread. That and as you mentioned off air, kind of walking away from some of the business, just some interesting things that you would think you would see maybe a little margin compression, not much, maybe flat even.
Well, this is typically, this is typically for brokerages where we see margins compress.
Yeah.
You know, when you looked at that spot rate versus contract rate chart, as spot rates increase and move towards contract, that is their margins.
Yeah.
Like that's what compresses. So this tells me that they may be having some success at getting some contracts coming at higher levels while still maintaining some pretty decent sourcing opportunities.
Yeah, absolutely. So just something that was interesting to me when looking through earnings reports and then with that chart as well.
And I want to hit on this as we lead into Dr. Rogers, because I want to get his take on the financial sector a little bit here. I know that's not his expertise or lane, but I think it's definitely something I want to hear his perspective on. We had the stock market have a decent little hiccup on Monday. Stocks collapsed. Now, there was largely resulting from the Magnificent Seven, which for those of you that aren't familiar, this is Microsoft, Amazon, Tesla, Apple, Google, Meta, and NVIDIA, all huge, high volume stocks.
Yes.
These are not necessarily indicative of their value being eroded. It's more of an easy way for investors to move money and liquidate their assets here because people are willing to purchase these. And so when we see these stocks move, it's not necessarily an indication that these companies themselves are having trouble.
Yeah.
It tells me that the investors are trying to get some cash and cover some positions. And that's what we saw happen. There is, of course, the carry trade component here, which is not something I'm going to break down completely, but basically a lot of investors, financial service people do tend to try to find these arbitrage opportunities, and this involves monetary policy across the globe. And so you borrow from a low interest rate government or I guess country, and then you invest in a higher yield, and then it expands your margin potential with that higher risk, coming the dollar, of course, being one of those right now. But this is just kind of a complicated thing that investors, when they get caught overindulging, because they do tend to flow into one single source. Yeah. Like once somebody figures out a strategy for making money, it starts to trickle into other places. And a lot of these investors simply have been caught as the Japanese monetary policy has shifted.
Yeah. I mean, didn't they just announce they're raising rates? I mean,
yeah, that's exactly what happened.
Versus the U.S., where we're talking about a cut, right? So it's like they're moving in opposite directions.
And the one thing that the carry trade requires is stability. And that's something that the VIX, of course, for those of you that follow this, shows we do not have.
No, not right now. I mean, I think some of this is, everybody talked about it, the unemployment number last week and kind of the trends there kind of as this trigger moment. It shouldn't have been to the degree that, we're still talking 4.3% unemployment. Like
still historically low.
Yeah. And it's trending slightly higher, but everything else is kind of still on some stable
people kind of reach for explanations to things that are complicated at times.
And then they then it goes extreme. And now the problem is everything, especially institutionally, is algorithm driven. Yeah. So some little trigger, they have to start, the algorithm's trained to start closing positions, and it creates this like just knock-on effect, basically.
And this appears to have more to do with the carry trade, which has actually been eroding since early July. It just happened to hit a moment where we think a lot of these algorithms are triggered because they start having to cover quickly. Yeah. These hedge funds have algorithms that trigger trades, and that's probably more of what happened than anything to take away from this economically, even though I think there are some reasons to be concerned about the labor market report. I don't think that you can take the stock market volatility as something of a signal of a recession.
No, I don't think so either. I mean, I think the one thing that maybe is the most concerning the labor market is what it's so lagged. I think
super lagged. It's already built in.
Yeah, I think the key is what does the consumer do as a whole from a consumer spending perspective. I mean, I was looking at Bank of America's card spending report through August 3rd, and I mean, down 1.7% year over year. Retail X auto down 3.5.
Yeah, I mean, all down. I want to talk to Dr. Zac Rogers about this, actually. I want to bring him on and get his take because he gets to see this whole supply chain top to bottom with the LMI. Of course, Dr. Z, let's bring him out here and start just rapid firing questions, and you can answer them as fast as possible. How's that work?
All right, that sounds great. Good morning, guys.
Good morning, and thank you for joining us. Summer break about over for you?
It is. I went into Costco and the lawn furniture is gone and the inside furniture is back, which is how I know that school is around the corner.
Here it comes out there in Colorado.
It's always dramatic for me when I see those Halloween costumes come out.
Good deal.
But yeah, let's talk about the economy.
Yeah, let's do it.
So, we had all these issues with the stock market, and it's funny because I always write this thing. I'm always kind of putting the finishing touches on Monday morning, and usually it's just little edits here and there. And then on Monday morning, everyone on Squawk Box is like, "Well, here comes the recession," and I knew that wasn't right. And the reason I knew that wasn't right is because just like you guys were saying, the fundamentals of the economy are fine.
Yeah.
Things seem to be okay. And really, if you think about it, a strong dollar, which is one of the things that people were worried about, is going to help us, I think, increase exports over the next couple months anyway. And if you look at inventories coming in to the West Coast ports, and you look at the increase in the trucking market, it seems like we're fine. People were worried. Tony, you mentioned that, the unemployment rate, or, we only had 114,000 jobs. The whole reason the Fed has been in this draconian system of interest rate cuts is to get the unemployment rate up a little bit and get the job market to cool down. So they did it. Now, I think they could have pulled back, honestly, on rates maybe 6 months ago, and it would have been fine. We always look at aggregate logistics costs. Which is we put together our index numbers for transportation price, warehouse price, and inventory costs. And one of the things that happens with that is we can really get a good idea of what supply-based inflation is. And we have a really high correlation with our logistics costs and supply inflation numbers that the Fed puts out. And, if you look at when inflation was bad, it was when our aggregate logistics price metric was like at about 240. So because we're adding together three measures that are 0 to 100, it goes from 0 to 300. And so when we were at 240, that was like the end of 21 and through the first half of 22. We've now been below 200 for about 2 years. And some of that was, okay, we had to sort of counteract all the high inflation with some low cost. But really, we've had low supply side costs for quite a while. And that's why you saw, I think, inflation really slow down in the last 6 months. The Fed, all they can do really directly is deal with demand side inflation. So like, the consumer piece of it.
Right.
And that was never the biggest problem. The biggest problem really was supply side inflation. The issue is that when all you have is a hammer, everything looks like a nail. And so the Fed has just been hammering away at the economy. And I think finally now, with this low jobs report and then, yen issues, it seems like maybe they're aware of that.
Yeah, I mean, I think it's spot on. And I think the big thing there is like you start digging in now that going into the LMI itself, I mean, up in July from where it was in June. I mean, continues to see expansion, seeing that capacity, transportation capacity and price, that inflection point continuing to like that gap between the two staying relatively wide. I mean, what's the takeaway from this report?
Sure. So transportation prices, the dynamic between price and capacity. So just to remind everybody, the LMI, we do a diffusion index. Any number above 50 means expansion. Any number below 50 means contraction, and then 50 means no change. So we have now had talking about transportation. Our transportation price curve this month in July read in at 63.8, which is the highest number we've had since May of 2022. Transportation capacity was 50.9. 50.9 essentially means negligible levels of growth. So we have a little bit of capacity loosening in the market, but really it's close to no change. And price is growing at a level we haven't seen since May. And this is the third month in a row. So now we've had a quarter, basically. Our transportation, somebody asked me this on a call yesterday. Well, can you say May, June, and July is a quarter? And I say transportation knows no master. Any 3 months can be a quarter for transportation. And so we've now had 3 full months. There you go, of that orange line being ahead of that white line, price being ahead of capacity. And anytime these numbers invert, as you can see, this is a really good predictor of where the economy is, especially the freight market. You can see going back there in this graph you put up from basically June of 22 until January of this year, capacity had been outstripping price movements, and price was actually negative most of that time, which is why we were really in the grips of that freight recession. We now have 3 months, 3 months of positive growth. The last time we had 3 months where we switched, okay? So, we have, as you can see, look in this chart, sometimes capacity goes up, price goes up, and they sort of toggle back and forth for a month or two. Anytime we've had 3 months in a row, though, in the 8-year history of the index, going further back even than this chart, anytime we've had 3 months in a row, that has meant freight recession over. Okay, now I'm not out here saying, ringing the bell, okay, the freight recession is over, but I will say it's ending. I think it's definitely, if you look at the dynamics, you look at the amount of inventory coming into the ports, I read some stuff, last week saying, oh, well, we had all this inventory come in June and July, but now it's really going to slow down because people are just trying to stay ahead of tariffs and things like that. Well, if you look at the port of LA, coming up through the last, I guess the third to last week of August, so through the week of the 18th, and look at the differences in TEUs year over year. This week up 27%, next week's 24%, week after that is 17, and that 17 is going to come up because not all the sailings are probably lined up yet. And so there's clearly inventories coming into the country. And that to me says that we're going to have something to do and something to drive around with trucks. Now, it could be a case where fleets become a little imbalanced again because we are seeing a disproportionate amount coming in West Coast because of issues in the Red Sea. We're not getting quite as much to East and Gulf Coast as probably we should. And so we will see, I think, fleets push towards California a little more than we normally would. But that will, honestly increase, I think, what they can do with some of those lanes. We could have some backhaul issues, but when was the last time we didn't have a backhaul issue? But I think it'll go forward. The other thing that makes me think this, by the way, is when we look at inventory levels and we split them apart by upstream and downstream. So downstream is our retailers. Upstream is like wholesalers, 3PLs, distributors, folks like that. The only negative number we had in this month's report was inventory levels, which was 49.5. And so it was just like barely negative. But really what that is, guys, is retailers are leaning out and they're staying JIT, and upstream is building. Okay. So upstream, our number was a 54.7, which is a good rate of growth upstream, especially when you consider that upstream was really shrinking and contracting for most of the last 2.5 years. And then downstream is a 40, which that's just JIT is all that is. And the reason we know that's JIT and not a real cut down in inventories is that downstream inventory costs were still at 61. And so that tells us when you have a growth in costs and contraction in inventory levels, what that tells us is we have velocity. So things are coming in and then they're heading out, basically. And so that, to me, what this looks like, we talked last time, hey, I think it's seasonality. I still think it's seasonality. It looks like we're building up a bunch of goods upstream that are getting ready to flow downstream as we move towards Q4. Oh, look at that! You guys even put little labels on all my eras. Oh, I like bleeding off. That's dramatic.
This chart is to just kind of show the different.
You guys hear me okay?
Yeah, I can hear you. Can you hear me? We good? I'm going to keep talking like you can.
Yeah.
Okay,
I can hear you guys.
Okay. So the point of this chart is kind of just define the different eras of inventory. Like, I don't think people understand clearly what inventory means in a lot of cases. Like right now, we're in this, what I would consider a more, like you just said, streamlined condition. My big question here, because you did say, you've already answered kind of the bulk of this. We've been hearing a large part about the consumer is weakening. They're not doing as well. And therefore, a lot of these retailers are giving signals that, hey, this isn't going to be a very robust economy in the second half of the year. But there's no data that supports that they are building inventories in any meaningful way, in my mind. Is there anything that we can't see from this data that you have concern that says, hey, the consumer is not going to show up in the second half of the year like they have been to an extent?
Not anything that I'm seeing, because we are seeing a lot of imports come in, and we are seeing a buildup upstream. And buildups upstream almost always are forerunners of buildups downstream. Christmas is still going to happen on December 25th. And if you look last month, we had Amazon Prime Day, right? Their best Prime Day ever happened last month. That, to me, doesn't say that the consumer is scared. I mean, maybe the consumer is slowed down right now, but, gosh, I was walking around Target with my kid last night. Plenty of people were buying back to school stuff. It was very hard to find a 5-pack of colored highlighters. I'll just let you know. And so there's nothing to me that says consumer contraction. When we look at our forward-looking metrics, inventory levels are at a 69 over the next over the next 12 months. Inventory cost at 75.5, and the freight market looks very strong for our future prediction numbers over the next 12 months. So to me, guys, I'm not seeing anything, and I mean, who knows? There could always be some black swan event or something happens. I'm not seeing anything that says the consumer is running scared.
I guess with that, what about the manufacturers? I mean, does that seem to be like hey, we're waiting for a rate cut to do anything significant or anything like that? Or is it?
That is exactly what they're waiting for. And that's what I would tell them to be waiting for. We have all this funding, this CHIPS money, all this stuff. But if you could get a loan at 4% instead of 7%, I mean, I would advise you do that. Like nobody listening right now, don't go buy a car this month. Wait a little bit until Toyotathon or whatever comes in November. Wait until the interest rates go down, and I think that's what we're really seeing upstream. And it's not just the manufacturers; it's also the infrastructure that goes around manufacturing. So we've seen a slowdown in some warehousing, especially on the fulfillment e-commerce side. But there's warehouses that are going to need to go into Arizona, into Texas, especially as we're nearshoring things out of Mexico or Central America, or even in the case of chips manufacturing in Arizona. There's all of this sort of support that needs to go around it. And people have really been keeping their powder dry. And so I would expect that as interest rates come down, we'll see an uptick in manufacturing, but also manufacturing construction. And that's great news for the freight market because construction tends to be big, bulky stuff. So if we're talking about things like flatbed, that could actually be really helped out, I think, by the interest rates finally coming down. And really, like we said in the beginning, it's time. We had fun, guys. What a laugh this has been. Let's now bring the interest rates down so we can get back to normal. I think it'll be great for sections of the freight market because it will not only charge manufacturing construction, it's going to charge up residential construction. I think we're going to see homes being built again once people can afford to buy a home. And so there's a lot of we've been in this funny position for the last year where up until the last 3 months, the consumers were basically dragging the economy away from being a recession. That was the strong part, was consumers. The consumers are tired now. I think they'll still spend on the holidays, but now where we see interest rates, it seems like they're definitely coming down in September. Now we can have the other part of the economy, the upstream, help as well. And it's just like lifting up a couch or whatever. We've been trying to move a couch with only one side doing the lifting. Now we're both going to lift together, and I think it's going to be
you're all
a strong freight market.
You are bull market heavy, and I like hearing it to an extent because that's interesting to me. But thank you so much for coming on the show this week. Hopefully we can have you on again to hear about this bull market recovery that you're talking about coming to fruition here in the next month or two. But yeah, that's awesome. I mean, he agrees with Craig's talked about it. He's very bullish. I'm starting to jump on this train a little bit. Maybe
data supports it.